Look, I think right now, any issuer interested in putting out a crypto product is going to do it because this is the friendliest regulatory environment we've seen for digital assets. Now's the time to throw everything at the dartboard and see what sticks. I think there are something like 150 crypto ETF filings out there. Is that right?
All right, joining me will be Adam Schenck, Principal and Managing Director at Milliman Financial Risk Management, who just a couple of weeks ago, they entered the ETF space by launching two first-of-their-kind ETFs. These hadn't existed before. The Milliman Healthcare Inflation Guard ETF, ticker MHIG, and the Milliman Healthcare Inflation Plus ETF, ticker MHIP. And in a nutshell, these are obviously designed to help solve for rising healthcare costs, which we all know healthcare costs have risen much faster than the general rate of inflation. Now, Milliman, if you're not familiar, this is a global consulting and actuarial firm that works with 24 of the 25 largest commercial insurers. They also serve as actuary for a large number of state Medicaid plans, and they have the majority of Medicare Advantage plans as clients. So they clearly know the healthcare space. And then within that is Milliman Financial Risk Management, or Milliman FRM as they're referred to. And they advise on approximately $242 billion in assets, including some $30 billion in ETF assets. I would say primarily buffer ETFs. So the asset management side is where these new ETFs reside. And Adam is going to introduce us to these two new ETFs, and we'll talk much more about the healthcare affordability dilemma overall. Now, to start this week, I'll be joined by Kirsten Chang, Senior Industry Analyst at VettaFi. And speaking of new ETFs, we're actually going to look at several recent launches that have caught our attention. And I keep saying it's becoming very difficult to keep track of all these new ETFs coming to market. I think we're getting something like 4 new ETFs every single business day. But it's funny, I'll occasionally look at the list of launches and be like, I had no idea we now have a BNB token ETF or another space-themed ETF or some new low-cost buffer ETF. But that is exactly why I like doing this podcast. I feel like it helps me stay on top of things. And so Kirsten and I are going to get into a number of these launches from over the past month or so. As always, questions or comments, you can find me on X at Nate Geraci, or you can go to etfprime.com. Okay, so I am now joined by VettaFi's Kirsten Chang. Kirsten, it's always great having you on the podcast.
Always a pleasure, Nate. Great to see you.
Okay, so I mentioned this fire hose of new launches. We've already had nearly 370 new ETFs this year. Think about that, 370 new ETFs in a little over 4 months. And that's after, 1,100, 1,200 new ETFs in 2025. So we're tracking to put up a similar number this year. But let me offer a few quick highlights to get us started. So, and I know you're already aware of this, but the top launch this year by far is the ProShares Genius Money Market ETF, ticker IQMM. That launched in mid-February, and it's already over $22 billion in assets. And it's actually one of the top ETF launches ever, though we should note a lot of that money has come from inside the house because ProShares is using that ETF for cash management purposes and their other ETFs. But nevertheless, that's still the top launch overall. And then the top launch in terms of organic inflows is the Roundhill Memory ETF, ticker DRAM, which launched at the beginning of April, and that's already at about $3 billion in assets. It's been a huge success story, and I want to ask you about that one in a moment. And then I'll just note, Kirsten, that if you look at the 370 or so new launches, it seems like everybody's been involved here, right? We've seen the largest issuers, iShares, Vanguard, State Street, and then brand new issuers such as Milliman, who I'll be visiting with a bit later. And so I thought to start, just give me your overall impression of new launches this year. What are you seeing big picture?
Yeah, it's really incredible, Nate. We already had record years for launches in 2024, 2025. And so for anyone waiting for that ETF fatigue to set in, that's just nowhere in sight. I mean, the industry just keeps kicking into higher gear. I think We were just shy of 300 by this time last year, and 80% of all launches have been inactive. So clearly the engine of ETF innovation is alive and well. And to your point, on one side, you have the big three, firms like Fidelity, JP Morgan, flexing their massive distribution arms. But then you have the more surgical entrants like Milliman, who you're having on later, coming in with very specific high conviction toolkits. And so it's interesting. What we're seeing here is essentially the democratization of the hedge fund, right? We're giving advisors access to these sophisticated strategies, whether it's return stacking, structured credit, or specific inflation hedging that they used to be locked behind a 2 and 20 fee wall. So clearly the ETF wrappers won the format war, and now we're just seeing how much utility we can cram inside of it at this point.
I just get a kick, like I mentioned, that we cover this industry for a living, and I can barely keep up. I can only imagine, like, if you're on the periphery or you're just an investor out there trying to look at the what's in the toolbox, it's very difficult to keep up with everything coming to market.
Yeah, due diligence really is more important than ever. I mean, more than 5,000 products out there. It's kind of insane.
All right. So as I mentioned, we're going to go through a few ETFs that have caught both of our attention, some of these new ETFs that have stood out. And I mentioned DRAM, the Round Hill Memory ETF. I think that's stood out to everybody clearly. But along with that, you mentioned to me two other ETFs that are tied to the AI infrastructure trade overall. The Dan Ives Wedbush AI Power and Infrastructure ETF, ticker IVEP, and then the Sprott Rare Earths ex China ETF, ticker REXE, both of which launched around the same time is DRAM. And so we are starting to see issuers get more granular in slicing and dicing the AI trade. Do you want to talk about those ETFs?
Yeah. To your point, I mean, busy month for thematic launches, more granular, as you're saying. I think, when it comes to the AI trade, we've now moved past that buy the index or just buy NVIDIA phase. The last 2 to 3 years were more about LLMs. I think this year is about the physical constraints. So issuers are solving for the bottlenecks of the AI revolution. I wrote about this last week, actually, but the bottleneck of the AI build out has shifted from chips and memory shortages to power and energy infrastructure. So if you don't have energy, you can't power up the chips. So if you look at, IVEP, the Dan Ives fund, that's a picks and shovels play for the electricity age. The market is finally waking up to the fact that you can't have an AI boom without a massive physical upgrade to the electric grid and data center cooling too. So the fund is investing in the physical backbone of AI, a lot of focus on utilities and industrials versus software. And then you have DRAM, the first pure play memory ETF that hit 1 billion in just 10 days, now $3 billion. So fastest, one of the most successful launches in history. And I think it's a sign that investors are eager to isolate and gain access to specific parts of the semiconductor value chain. So, memory is notoriously cyclical, but thanks to AI, there's now super cycle for demand. And so by slicing and dicing the trade this way, investors can now say, I believe in the AI story, but I want to bet specifically on the storage or the power infrastructure aspect that make it possible. So the trade is kind of moving from this broad brush to more of a scalpel. And then finally, REXE is designed that's tracking companies involved in rare earth materials, the mining and refining and processing of that. Right now, China controls the majority, by the way, of the world's rare earth mining. They also control the refining and the plumbing behind it. So the goal here is really to diversify away from that supply chain. And, rare earths, if you think about it, they're the oil of the green energy economy. One EV requires hundreds of pounds of this stuff. So I think the fund is also particularly relevant right now because governments around the world are providing massive grants and loans to help companies bypass the Chinese monopoly. So for investors, it really functions as a thematic sort of nuts and bolts play on the EV revolution.
Those rare earths are obviously critical to energy, which you mentioned, and AI and data centers. And so that's how they're tied into this AI trade overall. But it's amazing because you are seeing, again, this AI trade get much more granular. It started broader, and now you're seeing issuers slice and dice every which way. I think we're going to continue to see that. Okay, so besides AI and AI infrastructure, another hot area in ETFs is clearly space-themed ETFs. So there have been a number of new launches this year, including the Tuttle Capital UFO Disclosure ETF, ticker UFOD, the Round Hill Space and Technology ETF, ticker MARS. And then just over the past month or so, we've seen the Tema Space Innovators ETF, ticker NASA, and then the Global X Space Tech ETF, ticker OrbX, roll out, which, by the way, all of those great ticker symbols, I keep talking about that in the space category. But tell me what you think, Kirsten. I feel like this is all just pre-positioning ahead of the SpaceX IPO. I think to hopefully ride that wave, which I'm not saying that's a bad thing. I just think that seems to be driving the timing of these space themed ETF launches. Do you agree with that, or do you think there's more to it than that?
No, I think you're exactly right. Everyone's racing to plant their flags in this space before SpaceX IPOs, which, last I checked was valued at $1.5 trillion. So we saw the same behavior kind of before the Coinbase IPO with crypto funds. Everyone wants to be first. And, we're also seeing the government getting more supportive of the space saga because Artemis 2 just came back, generated some more buzz around that area. But I think there is kind of a real first mover hurdle here because another cool ticker, UFO, that's the Procure Space ETF, that's been the OG in this space for years. And that's seen a huge spike in interest lately because it has that established liquidity and that brand behind it. So if you look at it, I think it's tripled in size and hit maybe more, $500 million this year. I think now it's at $700 million and it's up 30% or so. And by the way, VettaFi provides the index for that, and that index did just get an update to now allow for day one inclusion of mega cap IPOs to prepare for that SpaceX launch. And so then you have the newer entrants like Mars, which is a bit more of a pure play, or NASA, but they do have to offer, I think, a radically different tilt or significantly lower price point, which could be hard to do when the underlying basket of actual space stocks is pretty relatively small right now. But yes, investors have definitely flocked to space ETFs ahead of that summer IPO.
Well, I'm very glad that you brought up UFO. I actually have the updated asset total on that. And you know why? Because I'm going to have Andrew Channon, who is CEO of Procure AM, on the podcast next week. So I was doing a little early due diligence. And I'll just give you a fun stat here. So UFO has gone from about 50 million in assets a year ago to over 750 million as we sit here today. And so it clearly has that first mover advantage. I think Andrew's been waiting for this moment for like 7 years. I think that launched in 2019, but there is a lot of competition coming in. So I mentioned those four ETFs that have launched this year. If you look at filings that are out there, there are currently filings from First Trust, Wisdom Tree, Vista Shares. So you have a lot of issuers looking at this category as well. We were talking about the AI infrastructure trade and that getting much more granular. It's the same here in the space category. And if you look at a lot of the ETFs that have come to market recently, they're actively managed as well versus, as you mentioned, UFO is index based. So I think that's another interesting component as well. But I'm going to go in depth on this entire category with Andrew next week. So shameless plug if you want to learn more about that. Okay, if we move on to some other new launches over the past month or so, please don't laugh at me. I think we have to mention a few crypto-related ETFs, which that's also a hot area for product development. And I'm just going to lump several of these together. So I alluded to this at the top, but we've had our first BNB related ETF, the Binance coin. So Teucrium last week, they launched the XETF's 2 times long BNB ETF, ticker XBNB. We've also had the first HYPE related ETF, the 21 shares, 2 times long HYPE ETF, ticker TXXH. There have been several Chainlink ETFs, Avalanche ETFs. I'm sure you know exactly what all of these crypto assets are. GSR, they launched the Crypto Core 3 ETF, which that's an index-based product. But the point being, Kirsten, is again, this is clearly a category that issuers are targeting. So any big thoughts here?
Yeah, I was wondering when the crypto question would come up. Look, I think right now, any issuer interested in putting out a crypto product is going to do it because this is the friendliest regulatory environment we've seen for digital assets. Now's the time to throw everything at the dartboard and see what sticks. I think there are something like 150 crypto ETF filings out there. Is that right?
It's somewhere. I've lost track, to be honest with you.
Yeah, yeah, it's piling up on the desk, but it's all about having that placeholder, that first mover's advantage, even in a lesser known token like maybe a hyperliquid. The SEC just took steps to accelerate the approvals process for crypto ETFs. We just had a big resolution with one of the sticking points in the Clarity Act this weekend, so a lot of wind in the sails on the regulatory side happening there. But I think these launches kind of show that issuers believe the crypto curious advisor is evolving into the crypto specialist now. I think they're looking for specific ecosystem exposure, whether it's the BNB chain or yield bearing structures. I think thousands of new crypto tokens are created every month. The barrier to entry is getting pretty low. So I think crypto ETF issuers are always going to find white space. They'll make it. I guess the question is there real demand for these products? Are you seeing that, Nate? I mean, you follow crypto much more closely than than many.
I think you just hit on the $1 million question is what type of demand. And I've talked a lot about this. Clearly, if you look at the top of the cap spectrum, assets like Bitcoin, Ethereum, the ones at the top of the cap table, we've seen the demand there. But you have this long tail of crypto assets. And is there going to be real real institutional demand for those? I think that remains to be seen. I think I've talked a lot about this on the retail side. I think some of these smaller crypto assets, issuers may be hoping that they gather a retail audience, but I might make the argument that a lot of that retail crowd is already pretty crypto savvy, and if they want to invest in some of these assets, they're going to do so directly, or go to Coinbase or whatever. And so I don't know how much demand you're going to get in the ETF wrapper. I think a lot of the demand we have seen in the ETF wrapper, certainly there's been retail demand there, but I think what's given the big push here more recently is institutional demand. It's advisor demand. And I don't know if you're going to have that as you get down to some of these smaller crypto assets, but we'll see. And I will say I'm still very bullish on crypto index ETFs, partly for this reason that if you are the crypto curious advisor and you want to allocate to the space, you may not know what Hyperliquid is or Avalanche, but maybe you want a little bit of exposure because these could be significantly larger crypto assets down the road. And so having an index-based approach is a good way to get exposure here. But by the way, speaking of demand, we should probably mention the two most successful crypto ETF launches this year, the Morgan Stanley Bitcoin ETF, ticker MSBT, and then the iShares Staked Ethereum ETF, ticker ETHB. So MSBT, that launched in early April. And I don't know if you've looked at this, that's already over 200 million in assets, which I think is impressive just given spot Bitcoin ETFs launched more than 2 years ago. So they were very late to the party. Of course, they came in lower cost, but I think that's a pretty good debut. And then ETHB, that launched in February. That's already over 650 million. I don't know if you have any quick comments on either of those.
Yeah, I mean, I think the success of these funds just proves the big brands still have a massive advantage even in this space. I mean, when a trusted issuer puts their stamp on a digital asset product, that in itself de-risks the category for a lot of institutional-minded advisors. I think they, despite being so new, they were able to garner these inflows. So it's less about which coin is better and more about which wrapper do I trust. So I think if you're an investor looking to wade into the waters of crypto curious, you trust a legacy asset manager brand name first, maybe over perhaps a smaller shop. And in the case of the ETHB, I think BlackRock added some yield too by operating as a validator of the fund itself, on behalf of investors. So these legacy names tend to bring a lot more institutional heft with them.
Yeah, I just find it interesting on the iShare side, they have two Ethereum products out there and, both now have sizable assets. So, one staked, one unstaked, but I think that's an interesting approach to the market. Okay, let's now go from crypto to something a little less exotic. Fidelity, they just rolled out 4 more ETFs to add to their enhanced lineup. So there's a small cap growth ETF, ticker FSEG, a mid cap growth ETF, ticker FEMG, a small cap value ETF, ticker FSEV, and then a mid cap value ETF, ticker FEMV. And I was looking, I believe there are now 12 of these enhanced ETFs overall. They've been rolling these out over the past several years. And I guess I'm interested, Kirsten, these were some launches that you pointed out to me that caught your attention. So why was that?
Yeah, I think Fidelity, they haven't been shy about trying to become an active powerhouse, and their aim is to be the third largest active manager. I think they're now fifth or sixth on the list. So they're making big strides with these launches. But I think pricing and precision are really key with these new funds. Bringing these active systematic strategies to market at 23 to 28 basis points is kind of a shot across the bow to a lot of traditional active managers. And I think that's what has brought them such a loyal advisor base. But again, I think it reiterates the notion that active in 2026 doesn't have to mean high fee. So Fidelity is tapping into its sort of deep quant capabilities here, and they're using tech and the data to tilt the odds in your favor in the parts of the market like small caps where maybe information gaps still exist. But they're filling out the growth and value tilts in those spaces. And I think they're essentially giving advisors a more sophisticated Lego set, if you will, to build a custom factor portfolio. They're not just trying to hit home runs necessarily. They're just trying to provide consistent model-driven alpha. So it really just rounds out their suite of available core building blocks. And all this targeted small cap exposure for essentially the same price you were paying for closet indexing just 5 years ago. But, I do think after years of underperformance too, the small and mid cap space is finally seeing some tailwinds this year. So it'll be interesting to see how these launches do.
Yeah, I definitely agree on the small and mid cap space. I'll just note, and I've noted this multiple times because I like to victory lap my own predictions that I make every year. I said smart beta ETFs would make a comeback in 2026. And I know technically these aren't what you would think of as smart beta because they're actively managed. However, if you look under the hood, these are really quantitatively driven strategies. And so I would lump those into the smart beta category overall. And I have seen this trend where I do think moving away from traditional active management where you have some rules based processes is attractive to advisors. And if you can offer these strategies at a low enough price point, which Fidelity is doing, I do think there's clearly some runway. And if you look at that enhanced lineup overall, they've had some success there in terms of the total assets. So interesting to see them continue to build that out.
Yeah, it's the institutionalization of factor investing.
Exactly. Yeah, and I think again, I'm bullish on that category. All right, so we're hopping around a lot here. I know there's a lot of new launches we could spotlight, but I'm going to go with these new buffer ETFs from Corgi. Am I saying that right? Corgi? Have you seen these?
Like the dog?
Yeah, that's what I'm going with Corgi. So they launched three ETFs, including the Corgi Growth and Technology 15% Structured Buffer ETF. The ticker symbol is QQMY. And notably, Kirsten, the expense ratio on these 30 basis points, which makes them some of the cheapest buffer ETFs on the market. I think Aptus has some at 25 basis points, but again, very cost effective compared to what's on the market. And I guess my question for you is, does it surprise you at all to see a new issuer try to enter the buffer ETF category? Because there is a lot of competition here. When you think of Innovator and First Trust and some of the others that have been here for a while, do you think there's still room to compete?
Yeah, it's a fair question. People have been calling the buffer category saturated for a couple of years now. We did see Goldman's acquisition of Innovator. That's kind of reset the competitive bar overall, making it really tough to compete with these giants. But what Corgi's doing with this launch is just fundamentally changing the math, right? It's a totally new face to the ETF space. I think they launched their first ETF just December. But 30 basis points for a buffer ETF, that's a massive disruptor. That's half the cost of your average buffer ETF on the market. If you can get a 10% or 15% downside hedge for the price of a standard active fund, that changes the math for a lot of more conservative retirees out there. I mean, the buffer category is just blowing up. It's getting close to like $90 billion. I think still strong inflows this year. So again, we're seeing risk management being baked into the base layer of the portfolio rather than being a premium add-on. And so one of the funds you mentioned, QQMY, that already hit like 5 million in trading volume on the first day. So clearly that you can compete on price, if nothing else.
Yeah, and that's what I guess I'm fascinated to watch because again, some of the entrenched players, they've been here for a while. They have a good reputation, known brands, and how discerning are investors and advisors going to be looking at the expense ratios on these buffer products? I think history would tell us that they are pretty discerning. Maybe it takes a little bit of time, but they are pretty discerning, and ultimately the cost does play a big role. So I think again that's something to watch. I've been watching that with the Aptus ETFs as well.
Yeah, I mean, in a sense, these new entrants they could be forcing the entire category to justify their margins in a world where projection is just getting cheaper by the day. So we'll see what happens here.
Okay, just a couple minutes left here before I let you go on the topic of new launches. I'm not sure if you saw this, but prediction market ETFs were expected to launch this week, and they're now apparently being delayed. I think maybe just until next week. It looks like the SEC wanted some additional information around disclosures and how these things would work. But clearly, the SEC is still trying to get comfortable here. And I thought back to when you were last on this podcast. I'm sure you recall we went in depth on prediction market ETFs, and you and I were both talking about, okay, how are these going to work? We were talking about creation redemption, all of the underlying mechanics. Clearly, the SEC is looking into this as well. And I think, again, just from a disclosure standpoint, to make sure investors understand the risk. I guess any new thoughts or comments around this space? It looks like they'll be coming to market next week. We'll see.
Yeah, I mean, I think like we said last time, this really feels like the Wild West moment of 2026. But I guess they are questioning the plumbing behind it, the SEC, how to package these binary yes or no outcomes into a daily traded ETF. And it's interesting, we just heard the CFTC come out and call prediction markets financial derivatives, right? Saying they should be treated as regulated derivatives exchanges and not just Vegas in a wrapper, not gambling. And so I think by doing so, they've taken power away from state gambling authorities and expedited this whole process. So we'll see what ends up happening. But again, just still a lot of concerns about that creation redemption process, and during periods of stress, the idea that APs might step back, leading to ETF prices deviating from the NAV. So I don't know. While these products could really open up the space to retail investors, it's interesting to see how the regulators handle this. But it does seem like, it is coming.
By the way, I saw a headline yesterday from the Daily Upside, which I thought you might appreciate. The headline was something along the lines of, will prediction market ETFs launch this week? Yes or no? And I like the binary outcome. I thought that was pretty good.
There you go. Yeah, go on, Kalshi to
yeah, I love that. On a more serious note, though, I don't want to get back into the whole debate around prediction market ETFs, but I will provide a stat for you, which you may or may not have seen. Wall Street Journal, they had a pretty long piece on prediction markets just in general. This was, I believe, yesterday. And they did some of their own internal analysis in looking at poly market accounts. And what they found was over 70% of poly market users lose money. And then they also found that 67% of the profits go to just, listen to this, 0.1% of the accounts. And really what they were getting at is that if you look at who's making money off these platforms, it's like professional market makers and traders, and it's at the expense of retail. And, I'm a huge proponent of the ETF wrapper. I love the innovation in the space. I do still have some concerns around that. I keep saying it's all DraftKings now when you look at some of these ETF launches. Now, I also know you can use some of these prediction market ETFs when they hit the market for serious hedging capabilities, that if you want to say, hedge the outcome of an election, and you think, for whatever reason, you want to take one side or the other, these are going to give you the opportunity to do that. But I do think there's going to be a lot of conversation around, is this all just gambling in an ETF wrapper? And we can start at, say, elections. What happens if we get, there's been some other filings that have come out for prediction market ETFs that move beyond the elections. And I just wonder how far this is going to go.
Yeah, I agree. I think that, I come from an acolyte of Jack Bogle, Bob Pisani, right? So we believe in long-term investing and in using ETFs in the stock market to make the bets, not real gambling, Vegas style. Because I do think this is making it too easy for retail investors to access this kind of gambling. And to your point, they're losing money on it. It's not benefiting the masses. So I think innovation is great. We should always cheer financial innovation, but the ETF wrapper is making it very easy to introduce all sorts of new products that may or may not be benefiting the greater good. So I share your concern.
Yeah, why do I feel like this is going to be a conversation you and I will be having again once these are actually live in the market? We'll see what these look like. But Kirsten, always fun chatting. That was a nice little tour through launches over the past month. So I had fun with this. Thank you for joining me.
Yeah, thanks so much, Nate. Great covering the gamut with you.
That was Kirsten Chang, Senior Industry Analyst at VettaFi.
Looking for ETF options from one of the top asset managers in the industry? Visit i.fidelity.com/ETFs to explore Fidelity's lineup and more. Fidelity Distributors Company, LLC, 500 Salem Street, Smithfield, Rhode Island, 02917. Fidelity Investments is an independent company unaffiliated with VettaFi and other third parties on this podcast. There's no form of legal partnership, agency affiliation, or similar relationship between VettaFi, Fidelity Investments, and other third parties on this podcast, nor is such a relationship created or implied by the information herein. Fidelity Investments and/or Fidelity refers collectively to FMR LLC, a U.S. company, and its subsidiaries, including but not limited to Fidelity Management and Research Company LLC, FMR.
I'm now joined by Adam Schenck, Principal and Managing Director at Milliman Financial Risk Management, who recently entered the ETF space by launching 2 healthcare inflation ETFs, which both use a first-of-their-kind investment strategy really designed to help solve for healthcare affordability. So I think we're all well aware of how quickly healthcare costs are rising, and Milliman FRM has developed a potential solution to this in the ETF wrapper. And I should note that Milliman FRM, they advise on some $242 billion in assets, $242 billion, including serving as a sub-advisor on some 30 billion in ETFs, including innovators buffer ETFs. But they've now launched their own branded ETFs, and Adam is joining me from Chicago. Adam, it's a pleasure. Welcome to the podcast.
Glad to be here, Nate. Excited to have this conversation.
All right, so I thought let's start with some quick background on Milliman and Milliman FRM. I just mentioned the 242 billion in advised assets. Maybe talk about that and just give us a brief snapshot of Milliman overall.
Yeah, so Milliman was started in 1947 by two pension actuaries, and then that business evolved over time into what we call disciplines of focus. So 4 different disciplines, essentially, mostly actuarial in nature. But as I sit here, we have shoehorned an asset manager into this firm. So in the 50s, we started our foray into health. So in 1956, we started publishing our first healthcare cost guidelines, and we still do that today. So since 2013, we've been publishing them on Bloomberg as other indices are called, and we call those the Milliman Health Trend Guidelines. And then we have a bunch of other indices and research that we do that I'll touch on. But then on the financial risk management side, we got our start in 1998, emerging from the life discipline, so helping life insurance companies. So back in the late 90s, they were issuing products, had just started to issue products called variable annuities, which you may be aware of. Some folks may be aware of those insurance products that are linked to markets. And so we help them to hedge the market risk embedded in those products. And that's where the lion's share of that 242 billion comes into play. But we've been doing that since then, all throughout the financial crisis, through the dot-com bubble, and then got our start in the ETF space as a sub-advisor in 2016. And as you mentioned, worked for the likes of Innovator. So not new to the ETF space, but essentially new with our name on it now.
And we'll obviously get into detail on both of the ETFs that were recently launched, but I guess just high level, can you take us through the decision to enter the ETF space? Why launch these products, and what was the problem that Milliman was attempting to solve, and why do you think you can solve it?
Yeah, so this all started 3 years ago. I got together with some of the partners on the health side, and we started to talk about how can we help essentially our clients. And then as it started to evolve, our mission is to serve our clients to protect the health and financial well-being of people everywhere. And we started thinking about that people everywhere piece to actually wrap this in an ETF. So healthcare costs have been rising much faster than inflation and have been for a long time. In fact, if you look at the average rate of increase over the last 20 years, it's on the order of 2% to 3% higher than inflation, and it's actually more than double lately. It's been running at 7% by our calculations, where we've got CPI and PCE closer to 3. So we wanted to create these products because we see that our clients are experiencing, the cost pressures of covering healthcare, and so we thought let's put together something that helps both our clients potentially manage the risks that they face with these skyrocketing costs, but then also offer them to everyday people for retirement savings, so you can get ahead of the issue of saving for healthcare costs in retirement.
Okay, so if we look at the ETFs, the first one is the Milliman Healthcare Inflation Guard ETF, ticker symbol MHIG. Tell us what's going on underneath the hood of this one. What will investors find?
We start with the Milliman Health Trend Guidelines. So those are tracking claims. So we have a lot of data sources where we accumulate claims data, and then we look at the rate of trend of the increase in those claims. And we can look at it in 3 different subcategories. So pharmaceutical claims, both generic and brand name drugs. Hospital, we call it facilities, so inpatient and outpatient services. And then professional services are where you have your doctor's visits, specialty visits, things like that. So the first step is to, all of that data is as of 5 months ago. So we need to create essentially a nowcast for the claims. What is the trend we're likely experiencing right now, given the data that we have as of 5 months ago? And then we use machine learning techniques to, kind of fast forward that data to today, looking at different metrics in the labor markets and things like that. And then that health group turns that data over to us in financial risk management. And then we look across that data and in deep inside that data to figure out what companies are likely the beneficiaries of where that money is going. And when you do that on a monthly basis over time, you can correlate, better than at least doing it in a naive way by just trading, say, the S&P 500 or bonds to that objective. So on the investment side, we have essentially 3 sleeves of exposures that we use to track different pieces of the underlying problem. So I just mentioned using the claims data to figure out the companies that are benefiting from where the revenue is going. So that's equities. So primarily in the healthcare sector, although we do have a sleeve within the equity, our equity allocation that we call the supply chain, right? Because, AI is being used in healthcare. So Google, Microsoft, right? All that stuff is used, and that does permeate through and potentially cause, inflation in your healthcare premiums. We know that equities have idiosyncratic risk. They also have beta risk. When there's a sell-off in all equities, they tend to all be lumped together. Correlations go to 1. And so we have a diversifier bucket. That is liquid alternatives. So we give ourselves a lot of leeway to think about what's best in that. But right now that is gold, primarily gold. And we have some risk management techniques we use for that gold exposure. But that essentially diversifies equity in a way that's linked with inflation over time. So together, the liquid alts, essentially gold, and equities are a risk bucket. And then we have our de-risking bucket, that is treasuries. And the treasury strategy is dancing between short-term and intermediate treasuries. And that strategy you can think of as trying to match wage inflation, or the inflation that permeates into healthcare caused by having to pay people to apply, to administer that healthcare. So that's essentially how the strategy works for the guard. And then the plus ETF just takes more risk. So, and then deliberately tries to overshoot the current rate of trend that we see by about 200 basis points. So if we're seeing a trend of 7 right now, we're trying to achieve 9% return in expectation, with the plus versus the guard trying to earn that 7% return.
So Adam, if I were to try to summarize everything that you just described there, Milliman has these health trend guidelines that you mentioned, and these essentially measure healthcare cost and inflation in the U.S. And what you're doing is you're coming up with the proper asset allocation to keep pace with that rate of healthcare inflation. Is that fair if I were to just simplify it down to the most basic level?
Indeed. Yeah, that's exactly what we're trying to do. Come up with a basket of securities we can hold that gives us the best chance to meet that rate of inflation while mitigating market risk, right? Because you can trade the NASDAQ and exceed the level of inflation over time, but you're going to have a lot of risk doing that.
You mentioned both of these ETFs will invest in the healthcare sector. I know that's just one sleeve. And a question I have is, if I look at the returns from that space recently, and you know this better than anybody, they haven't been spectacular. So if I look at, say, the healthcare select sector SPDR ETF, ticker XLV, which maybe you don't think that's a great proxy for the healthcare space, and that's fine. I'll use that just as a reference. It's only up 15% total over the past 3 years, and about 28% over the past 5 years. And so I'm curious, how do you think about using healthcare related exposure in these two ETFs as a hedge for rising healthcare costs?
Yeah, so XLV, right, the sector is market cap weighted. So it's essentially just taking the information about how is the market pricing each one of these securities, and taking that as kind of the benchmark and then tracking that. I think you do need to look more closely at each one of these companies. So one example is in the device makers, right? So you can look it up. It's BlackRock has an ETF that focused just on medical devices, and there's companies in there that are conglomerates of that do a lot of different things. So Abbott Labs, for example, has been down over the last 5 years, but only 68% of the revenue is derived from claims. Hospital diagnostics and professional services diagnostics, where 32% is nutrition. And one thing that I think has impacted that stock in particular, for example, is they had a lawsuit, they have a lawsuit against their baby formula, for example, and that's kind of an idiosyncratic component of that company. So we're trying to look deeper into each one of these companies and find, looking at where they derive their revenue from, to how we can allocate to each one of those claims categories I described, so that we can track the revenues more closely and then align the portfolio better for the objective that we have in particular, which is matching that healthcare inflation. But we understand there's idiosyncratic things that happen, and that's why it's not only healthcare companies, because we know there's other companies that drive inflation in general. And so that's what I mentioned with the supply chain sleeve. And then the allocation of liquid alts does help ballast the portfolio in certain periods when you have lower returns in equities, and you need risk premium from other sources that's linked to inflation. So we try to be really specific about our allocations, and that can help in healthcare. And in one of the companies that has experienced some of the most appreciation over the last 3 and 5 years is Lilly, and that's our biggest holding. And that's because we see that pharma trends are greatly exceeding, in particular, pharma trends related to GLP-1s are greatly exceeding the trends of the hospital and professional services claims categories.
If we think about these ETFs more broadly, and you mentioned obviously there are sleeves in addition to the healthcare related space, but I think a question that some investors and advisors might have is, why do I need specific healthcare inflation ETFs? In other words, if I know healthcare costs are rising at, say, 7% annually or whatever, there are obviously plenty of other ETFs and funds that theoretically can meet that target. And so what's the potential benefit of using dedicated healthcare inflation ETFs?
It's really that even though over time you might beat the target with other investment categories, there's not a link between those investments, right? The value of Netflix is not really going to be correlated with healthcare. One, for example, in the financial crisis, if you look back to 2008, healthcare costs did not go down. So we had deflation in a lot of other things except healthcare. Healthcare kept going up, and that's because the demand for healthcare is not going to abate anytime soon. We've got, we're getting close to peak 65. right? There's a lot of people that really need healthcare. And then when you think about retirement, it's the third, greatest need you have. Number one is food. Number two is shelter. Number three is healthcare. So we think that you should have a sleeve in your portfolio, an allocation dedicated to healthcare expenses. We have, for example, papers we put out, the Milliman Retiree Healthcare Cost Index, and that index in the last print in 2025 showed that a couple that is so the cost for retirement for that couple for Medicare, a Medigap plan, and then Medicare Part D for drugs was $588,000. The median savings rate in the Consumer Finances Survey was $200,000. And then the average was $600,000, but the average is obviously skewed by really wealthy people that have a lot in retirement. So most people retiring do not have enough for retirement expenses in their lifetime. And we're just trying to sound the alarm. Like you really want to have a sleeve dedicated to this. And we put out a calculator on our website that you can just go in and play with for free. That'll tell you essentially what your healthcare costs will be upon retirement. So whenever you put in your current age, your expected age at retirement, the state you want to retire in, and your healthcare status. I'll give you a number for how much you're going to need when you retire, and then the present value of that today. And that's what we think essentially you should allocate toward healthcare expenses. And then what we're doing with our strategy is trying to create the link as best we can with the tools we have available to what could drive healthcare one way or another and the companies that benefit from that.
Yeah, and so that direct link is clearly what you view as a differentiator here. You have that direct link to healthcare costs and how you're allocating in a portfolio. Let me ask you this. Let's say healthcare costs, I don't know, Adam, quadruple or something like that, and we're now looking at 12 or 14% annual rising costs. Would the ETFs then get more aggressive to try and meet those increases? And like, how reactive are they? Does there need to be a much longer term trend line established at that higher level, or would the ETFs react more quickly?
So this is a monthly process we follow. So every month we repeat this calculation. We try to figure out what trends are likely are right now. And then we try to build a portfolio that in expectation meets those trends with risk management techniques that we've developed over the years on the life space. So if we started to see a trend of 12%, we're definitely going to get more aggressive to a limit. We do have limits for how much equity, how much gold versus treasuries on the high end and low end for both too, right? So we do have limits where we don't want to exceed too much to create too much risk for an investor. But yes, we would get more aggressive. And again, if trends are running at 12%, some of these companies are benefiting.
Okay, and I think you also alluded to this earlier as well, but I'd love to have you talk more about the audience for these ETFs. So as you can probably tell, I always come at this from a financial advisor or individual investor perspective, but my understanding is you do see a much broader range of potential investors for these products. So who might those be overall?
Yeah, so we obviously have a large bench of clients on the institutional side that we do a lot of work for now. On the actuarial side, helping them set the reserves, helping them set capital, but now we can actually also help them with their investment strategy. So certainly an institutional set of clients that we're talking to about this. But then again, that people everywhere component, that's the reason we launched two. And in not only for everyday investors, but we do see that some healthcare institutions might choose the plus ETF for their for their surplus. So the extra capital that they have to invest in other things, and that actually is commensurate with the risk tolerance they have for that extra capital. But on the individual side, the two give people a way to allocate again to try to save for retirement, but then the plus ETF being able to take more risk and trying to deliberately overshoot the bogey earlier in one's investing lifetime and kind of serve as a rough glide path, right? So we think that people that are younger, having more of their bases covered, having a higher risk tolerance, can invest in the plus in that retirement sleeve, but then keep track of how well they're doing. So, do you have enough? Repeat that calculation for how much you need to save for retirement as things change, as your health status changes, as you change your objectives and things like that. And then as you get closer to retirement, on the order of 55, that's where we see the Guard ETF coming into play. And then certainly we have, additional plans as we go forward. But that's how we see people using these. And again, we think it really does make sense to try to do this in your investment portfolio. Have this dedicated sleeve to keep up with healthcare costs.
What about using these in HSAs? I would love to see Milliman FRM maybe take the lead in pushing some of these plans to allow ETFs to trade, because as you know, ETFs aren't always accessible in HSAs, but these seem like an obvious spot for your ETFs.
Indeed. So triple tax advantage of HSAs. We are talking to some HSA providers. To the extent that you can let those balances roll over and invest in something like this, that literally those funds are used for healthcare expenses. If you use them at any time for healthcare expenses, you get to take them out tax-free, even after retirement. Even if you bequest them to heirs, the heirs get to use them for healthcare expenses tax-free. So certainly that is an obvious target for us, and we're working, try to get these on HSA platforms and help people understand that vehicle as well a little bit better. It seems like the administration likes the HSA vehicle, so there's a lot of discussion around potential expansion of that, but we'll see how that goes. But certainly, retirement vehicles are a good spot for this, and definitely HSAs.
Well, Adam, congratulations on the launch of these ETFs. I always love seeing innovation in the space, so these are clearly unique strategies we haven't seen before. Wish you the best of luck moving forward. Thank you for joining me.
Thank you so much, Nate. It was a fun conversation.
That was Adam Schenck, Principal and Managing Director at Milliman Financial Risk Management. That'll do it for this week's ETF Prime. Build your ETF expertise and separate yourself from your peers by registering for the ETF Institute Certified ETF Advisor Program. You can learn more at cetf.org. Next week, as I mentioned earlier, I will be joined by Andrew Channon, CEO of Procure AM. So we are going to spotlight the Procure Space ETF, which space ETFs have been a very hot topic this year. So we'll discuss everything going on there. And then I'll also be joined by Paul Bayaki, Head of Fund Sales and Strategies at SS&C Alps Advisors. Until then, have a great week, everyone.
ETF Prime is hosted by Nate Geraci, president of OTR Media, LLC. Nate is also president of investment advisory firm Nova Diaz Wealth Management. While OTR Media and Nova Diaz are related by common ownership, they are separate and distinct entities, and anything discussed on this program should not be construed as an official statement by Nova Diaz. This program is for informational purposes only and does not constitute investment advice. Investing in ETFs involves risk, including possible loss of principal. Any past performance figures discussed are not necessarily indicative of future results. Some guests appearing on this program may also be financial sponsors of ETF Prime. OTR Media and Nova Diaz are not affiliated with VettaFi or any of its affiliates. VettaFi's participation in this program should not be construed as an endorsement or an indication by VettaFi of the value of any OTR Media or Nova Diaz product or service. Visit etfprime.com for more information.